It was a strong day for the U.S. stock market with the S&P 500 closing higher by more than 0.6%. But what was odd about it is only about half the stocks closed higher today. So it was another one of those days where mega cap tech really ruled the roost, with really only Alphabet sitting this one out. The rest of the Magnificent Seven really pulled their weight here today. So we'll take a look at that, we'll see what it means for our postures. We'll have a chat about the 1040 crossover method and look at one index in particular that's getting close to a golden cross. Then we'll get into our trade application example, where I wanted to focus on a bearish swing trade since we did a bullish one on Tuesday. To offset that to a degree, I chose the healthcare sector and one stock that's kind of falling from grace here around its 30-day moving average. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's June 8th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. You'll also find which stocks are giving you overbought and oversold cluster signals at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on those Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's trade activity. And as you can see, I've got the S&P 500 heat map pulled up here in front of us. And it was a split type of a day. However, it was kind of leaning back towards one of those days where it was mega cap tech leading the way once again. So while we had about a 50-50 split between green squares and red squares here today, we actually had a pretty solid end result of the S&P 500, which was up about 0.6%. So not a half bad day, over a 0.5%. So anyway, let's go through some of the information. We see Apple had a pretty reasonable day, up 1.55%. Of course, a big day there for Apple, or a big week, I should say, with their announcement of their virtual reality goggles, and I'll be curious to see what sorts of businesses develop as a result of that. I don't think I'll be an early adopter of that, but you never know. Maybe there can be some interesting use cases, and maybe we'll all be wearing them 10 years from right now, even though we have some hesitations at the moment. So Apple has certainly pulled a lot of rabbits out of their hats over the years, and so you certainly don't want to bet against them. And today was a day where the world's largest publicly traded company just kept piling it on as we inch closer and closer to a $3 trillion market cap. You can see we're at $2.8 trillion at the moment. Microsoft also had a reasonable day. It was up about 0.5% here today. Nvidia soared once again. It was up 2.76%, so it's knocking on a door of a $1 trillion market cap again. Remember, it was there briefly for a day or two and then kind of fell out of favor there for a bit, and now it's kind of trying to gear up for another run perhaps. We had Meta that was up about 0.37% today. We had Amazon that was up 2.5% today. And then Tesla just keeps on rocking it. It was up 4.58% today. I think they said on CNBC that it was the 10th day in a row for Tesla to the upside. It's not really doing me any favors. As some of you know, we have a bearish trade on it in this Market Outlook video category in our paper money account. But it is a good reminder that the type of trade that I took there was a bear call spread. Where I did have defined risk, right? Other people who are just shorting the stock and just hoping for the best, they're getting run over right now, and it just keeps getting worse day after day after day. So yes, it was a poor trade on my part. I wish it would not have been made, but at least we know what our worst case scenario was, and we position sized accordingly, so we can afford to take those risks if we know what our worst case scenario is. So that one's been a little bit of a surprise, because it was just a couple of months ago Tesla was in quite the downtrend, and all of a sudden here it just takes 10 days in a row and things are looking pretty bright once again for Elon Musk's company. In terms of the mega cap tech focus types of trades out there, really the only holdout today was Alphabet. It was down 0.29%. So a little bit of a modest pullback there for Alphabet. Otherwise, those biggies were all in the green, and that really supported the market activity here today. Now, beyond those kind of 7 giants of our current world, we did have plenty of other things to discuss. Let's talk about Adobe with its let's see, a 5% type of a move here today. That's pretty aggressive for that company, which is a $200 billion company these days. We had Warner Brothers Discovery with nearly a 7% move here today, so it was doing quite well. And even T-Mobile had a decent day, up 3%. Remember, T-Mobile and Verizon and AT&T, they've had a challenging week here, as there were rumors that Amazon may team up with Dish to offer Prime members perhaps free or at least reduced priced cell phone plans and packages. So they have come out to deny that, but sometimes where there's smoke, there's fire. So without a doubt, Amazon has the ability to disrupt even major industries. So we'll keep our eye on that story. We also see that Boeing finally kind of start clicking once again. We actually own Boeing in our top-down trend trading class, but it had kind of been stagnant here for a while. So it'd be nice to see that one start to get some air under its wings once again. You can see here that Arista Networks was up about 4%. That's ticker symbol ANET, and that's one that we don't own in my top-down trend trading class, but it's always on my radar. It's got a pretty solid chart here recently, like so many tech stocks. That's kind of the challenge more than anything right now, is that there are so many great-looking trends out there, but that one has been a stellar performer for sure. In the healthcare area, we did have Gilead with a fairly nice day, up 3%, and then Vertex was up 2.5%. Off to the right-hand side here, we had O'Reilly up about 2.5% there in the discretionary space. McDonald's and Starbucks both closed higher by over 1% here today as well. In terms of kind of the losers now on the red side of the equation, I usually try to look for patterns, and I would say that energy kind of catches my eye today as being one that seems to be mostly out of favor. You had a few little green patches here and there, but it was overwhelmingly a bearish day there for energy. So it kind of put a little bit of a cold, wet blanket on that rally attempt that we saw here yesterday out of that sector. I would also say that financials kind of cooled off here a little bit today as well. You'll notice that Visa, MasterCard, Bank of America, they all struggled here today. The exchanges were up, so if you look up here, Intercontinental Exchange and CME Group, and some of those were up. Today, by the way, was the 40-year anniversary of that movie Trading Places with Dan Aykroyd and Eddie Murphy. So it was for those of you that are not my age, perhaps you have not seen that yet. If you're one of the younger millennials out there, I would encourage you to check out a true classic. It is a comedy, but it's got some interesting teachings about commodity markets and what it looked like in the old days when we actually had a lot of humans in the trading pits. These days, of course, a little bit more machines than anything, but a great movie that seems to stand the test of time. Turns 40 here today. We do have the real estate area that seemed to be a bit out of favor today as well, where I see a lot more red than green. So those kind of seem to be the areas that were a bit out of favor. But all in all, I would say it was a pretty reasonable day where it was a 50-50 split, but because the big companies largely closed in the green today, we actually had a pretty decent end result for the S&P 500. Let's check the specific numbers now, and you can see that I've got the S&P 500 public watch list pulled up here on Thinkorswim, and I've got I'm in the Market Watch Visualize area, and it breaks down how many stocks were up versus down today in the S&P 500, and you can see there were 254 stocks higher today, 245 down, and so that's about as close to a 50-50 split you can get. You could probably say 51% of stocks closed in the green today. Usually when you have 51% versus 49% in any given day, you're going to assume that the end result of the market was basically flat. So again, to stress the point that I was making before, let's now take a look at the charts, and you can see the S&P 500 actually had a really good day. It was up 0.62% today. And again, it goes back to that whole idea of market cap weighting, where in the S&P 500 and how it's calculated, it gives way more weighting and credibility to the largest companies out there, and it gives way less ability for smaller companies to make an impact. So just simply because of which companies were up today, it appears to the eye that we had a pretty decent day in the market, but you look underneath the hood and you realize it was truly just a coin flip. You had half as many stocks up as you had, down. So you had basically that even split there. So anyway, we do have the S&P 500 still kind of struggling to break through this resistance that we've been dealing with for the last 4 or 5 sessions now. We did have what appears to be a new 9-month closing high today, but we did not take out the 9-month intraday high. That still stands here from June 5th. So a good promising day, but not one that comes with a whole lot of fireworks. But perhaps that's in store for us tomorrow or early next week. We shall see. Remember, we're not very far away from those August highs of last year, so we could be talking about 52-week highs on the S&P 500 very, very shortly under the right type of circumstance. Naturally, when the market moves higher, there's a greater chance that the bullish posture is retained, and that's exactly what has happened here. We've had a strongly bullish posture here since the 31st of May. And even before that, we just had a one-day kind of blip where it went bearish for one day and then right back to it. So I always like to point out that if you look at this chart, you see very little in the way of background color that is pink. You have just a few areas here and there. So for the most part, I would say that the market forecast technical indicator has done a very good job of keeping you on the right side of the ball. It doesn't always work that way. For an example of that, down below here, the Russell 2000 does not look nearly as consistent. You had a lot of chop back and forth where it was giving you head fakes of bullish versus bearish, bullish versus bearish. But I would say that it worked for the S&P 500, and it really worked for the NASDAQ composite. I mean, that has been consistently green basically this entire 3-month period of time. So, sometimes, it just a simple indicator like that can help you stay on the right side of the trade. And I will stress that it doesn't always work, but no technical indicator always works, right? So we have to acknowledge that. In general, I say it's done a better than average job here in the last 3 months. So the S&P 500 remains with that strongly bullish posture. It remains above the rising 30-day moving average, and the green line remains in the upper reversal zone. Those are all things that you want to see if you want to be in an established bullish trend, which I believe we are with the S&P 500. With the Dow Jones Industrial Average, it was up 0.50% today, so slightly worse than the S&P 500, but all things considered, not a bad day for it either. Notice that the Dow closed near the highs of the session, and in doing so, took out that resistance area from the 2nd of June and the 5th of June. So that must have been a Friday, Monday back to back there, but we did close above that area. So that takes us back now to approximately, the first couple of days of May as far as when were we trading higher than that. So you can see that it wouldn't take a big move at all to get up and over this 34,200 level that now serves as our high here over the last 6 months. Not too far away from that at all. So promising day there for the Dow, even though the end result wasn't quite as robust. I would say that that's a good looking candle. That's what you want to see. Remember, the Dow has not been as straightforward as the S&P 500 and the NASDAQ composite. It's not like it has fallen apart. It just simply couldn't really get its wheels unstuck out of the mud. And so now it's trying to give you that attempt here. And it is interesting to note that the market forecast oversold and overbought cluster signals worked really nicely on the Dow this time around. Right? The whole idea behind them is that either the selling has gotten too aggressive or the buying has gotten too aggressive. Had you been buying the Dow back here on March 10th and 13th, when you had these little green dots showing up, you would have had a nice reversion to the mean rally until you saw this red dot showing up, which is an overbought cluster signal. So had you then decided to sell that position that you had in the Dow, and then you advanced time a few weeks and woke up and found out that we were at this other position of oversold cluster signal again and decided to get back into the Dow and have been riding that since then, that's worked out really nicely. Obviously it doesn't always shake out that way, but in this particular case, I would say that it has worked. And remember what I've told you guys for years, at least in my own head, and you guys don't have to believe this, but just from my own experience, I personally put a lot more credibility into the oversold cluster signals than I do the overbought ones. Doesn't mean that the overbought ones can't work. Obviously, this worked just fine. But there's a lot of other, stuff at play, including the Federal Reserve and their willingness to, maybe ease on interest rates or become more dovish, and that sort of thing just has a natural levity to the markets if you believe markets go up over the long term, which I do. And so I put a little bit more emphasis on the oversold clusters, those green dots, than I do the red ones. You can see with the NASDAQ composite, part of why I do that. With the NASDAQ composite, had you gotten out of it here on the overbought cluster signal, you would have been sad to not enjoy the ride up to the next overbought signal, and if you'd have sold there, you would have been sad not to ride it up to this other one, right? So you can see that the overbought ones tend not to work immediately if the market is kind of in a more bullish mindset. And remember, if you just divide up the days of trading throughout history, the market's going to be more bullish on more of those days than bearish. So if you're going to lean in one direction or another, it makes sense to me, at least, to lean more bullishly. So fighting against a really strong trend like this is not always in your best interest. But, every situation's a little bit different, and again, the Dow performed admirably from that perspective. The oversold cluster signals worked nicely, the overbought cluster signal worked nicely, the oversold cluster signal worked nicely. So, for those of you that were playing that game here over the last 3 months, congratulations. It looks like you navigated that quite successfully. So the Dow also has a strongly bullish posture at the moment, intermediate posture. Remember, unless you hear David and I say otherwise, if you just hear us talking about the quote-unquote posture, what we're referencing is the intermediate posture, this green line here. And it is at 65 and rising, so it's not in the upper reversal zone the way that the S&P 500 is, but it's definitely approaching it, and so it is considered strongly bullish there. And it is above its rising 30-day moving average right now as well. So similar to yesterday, we continue to have that green moving average there helping us identify that. On the bottom rung now, we will talk about the best performer and the worst performer today. Let's start with the best. The NASDAQ composite, once again, leadership group. And that makes sense given the breakdown of the heat map that we reviewed here earlier with stocks like Tesla and Amazon and Apple cooking to the upside, and Nvidia. Those are the types of things that will help support the NASDAQ composite to a greater degree than the other indices that are going to contain a lot more non-tech oriented areas. And so today was a tech-driven rally once again, and that showed up in the NASDAQ composite's end result, a nice solid 1.02% day for those tech lovers out there. You can see that, no surprise, we remain with the green line in the upper reversal zone, so we continue to have that strongly bullish posture on the NASDAQ composite, which has been in place here since May 8th, which was exactly 1 month ago. So this is an entire month where the strongly bullish posture, not even weekly, but the strongly bullish posture did not fall out of favor. In fact, that entire time, you had the green line in the upper reversal zone above the 80th percentile. So that has been a really solid, consistent type of a move there. And you don't see that all that often. It's hard for any index or stock to, retain that type of bullishness so consistently. And it just goes to show that this market has been, grinding higher up that wall of worry and has, benefited those that have taken that risk to the upside. Of course, the moving average color remains green as well. In that case, price is above a 30-day moving average that is also rising. Last but not least, let's talk about the Russell 2000. It was our laggard here today. it was actually down today when all the rest of the indices were up nicely. So today was a day when the small caps had to give some back. Remember, they have been on an epic tear. We talked about that Tuesday when I was last with you, and I'm sure David talked to you about it last night in his video as well. This thing has been just en fuego to the upside. So today's give back of 0.41% is really an afterthought, right? There's hardly anything to feel too bad about, knowing what has just happened to those small caps in just 1 week's time. This is basically a whimper of a pullback, hardly anything. This was actually a much more aggressive pullback here, and even that was not something that we should have been scared about. So, you know, the shape of the candle is perhaps a little bit more concerning than the actual end result. The reason for that is you got that long lower shadow there. And remember, where you have the long lower shadow is what's important. It's not the fact that the long lower shadow exists, it's where it is placed on the chart. When the long lower shadows are at the bottom of the chart, particularly at a support area like this one was on May 4th for the Russell 2000, because it was the same horizontal support area that was capturing some interest of buyers back here in March, this would be an example of a hammer. And a hammer is a bullish sign. It hammers out a bottom and reverses back to the upside. That's the hope, at least. When you have the exact same looking candle that shows up at the top of the chart and not the bottom, it's the exact opposite impact, generally speaking. Sometimes referred to as a hanging man, but generally, not something that you want to be involved with, generally speaking. It's a pretty grim sounding candle there. And you can see that this could be identified as a bit of a resistance area. Where we touched yesterday was effectively the same area that we were touching exactly 3 months ago on the Russell 2000. So after such an aggressive up move in just 1 week's time, maybe this is a little bit of a toppy type of a pattern here at this moment. Now remember, when I say toppy, I don't mean that it's going to immediately go back into a downtrend. In fact, this was an aggressive enough move where I think this was a trend-changing type of move. Sometimes they're aggressive, sometimes they're whimpers. I call this one aggressive. So even if there is a give back, let's say in the next week or so, my expectation right now is that it would reestablish the support levels and the higher lows and the higher highs, and it will continue to be bullish into the future until proven otherwise, right? And I'll be happy to be proven wrong. I am often. That's the nature of this business. But we have to go forward with expectations. And right now, my expectation is this was such an aggressive move out of the small caps that if we give some of this back, which will be natural, I'd like to see it come down here to about 1810 or thereabouts. And if it can stabilize there, I think this is still a very healthy looking chart. The reason I'm picking that level, if you can kind of use my crosshairs there that I'm using in gray and move your eyes towards the left, you can see that right around May 22nd, we had a touch point, right around April 17th, we had a touch point, and right around April 1st, we had a touch point. So that used to represent a bit of a horizontal resistance area, and oftentimes when horizontal resistance areas are broken to the upside, you have that sensation known as a breakout retest. So you've had your breakout and it's been an aggressive one. Now it might be time to retest those levels, but that becomes a very important battleground zone between the bulls and the bears, and that's where you might find some other willing buyers now that we've kind of broken up to that next level of the apartment building, so to speak. So let's keep our eye on that possibility. Today's candle doesn't look particularly good. I'm not too afraid of the end result. It's definitely due for a breather, so that did not scare me, but it is at least noteworthy that this is not the type of candle you want to see up here at a resistance area. So it might be the market telling us that it needs a little bit of a breather, give back some of those gains, make some people second guess their decision to get into it, and then kind of gear up for another run if it can stabilize around 1810. So let's keep our eye on that possibility. By the way, we almost had a bullish intermediate confirmation signal. We just missed it. You'll see here that the red line closed at 20.33. Remember, you can read that a little easier in the label there. In order to have the bullish intermediate confirmation signal, we would have needed that red line to officially be below 20. So it missed it by the narrowest of margins there. So, perhaps that will happen tomorrow. Let's keep our eye on that possibility. Let's go ahead and take a look here now at our 3 green arrows chart. This will be chart 4D for those of you that are premium members following along at home. And as it stands right now, good news on that count, we have 3 green arrows across the board. That's not something that we should take for granted. We've had a lot of differences in these charts this year. It hasn't been just everybody's doing the same thing. So right now happens to be one of those times where all 4 of these charts are pretty consistently bullish at the moment. So whether you're looking at the 30-day moving average, the MACD, or the stochastics, all of them are giving bullish signs on all 4 of these major U.S. equity indices. So that helps support the bullish postures that we were already talking about on the last set of charts. So, a lot of times you like to see that confluence of lots of indicators giving you either bullish or bearish indications at the same time. And right now you could make that case that we are getting a confluence of factors supporting a bullish move in the market here at the moment. Let's take a look at a longer term chart now, the 1040 crossover method with these 4 same indices. And we have reasonably good news there as well. As we pull this up, a reminder that this chart 4C will look at 3 years worth of information as opposed to 3 months that we've looked at in the other charts so far. So this is a much longer look back here, where we're looking all the way back to 2020 in this case, back to basically just the aftermath of the COVID wipeout period. And you can see that markets are up nicely from that COVID wipeout period, despite 2022 being a very difficult year for most investors out there. So again, it proves the point of long-term endurance, right? I actually just got done retweeting something I was thinking about earlier today with this one that I had posted actually last year. But I say, dividend growth investors, stick to your game plan. Don't be dejected when fad stocks roar higher and leave you in the dust, which is kind of what's happening right now for dividend investing. And in the long run, quality wins out when it's most important. So at some point, they will come roaring back as well. But, it is that belief of that long-term investor. I'm not going to show you this whole thing. It's a minute 40 if you want to check it out. Go to my Twitter feed. But it's an amazing race where this guy here in the hat in the back he goes on an eventual tear, even though he was basically in last place for most of the race. So it kind of reminds me of this whole notion here with these charts as well. Sometimes we get so caught up in the negativity in the day-to-day, like what happened in 2022, we forget that markets are upward leaning, meaning that all else being equal, assume markets go higher because quality stocks and quality businesses, more to the point, will be worth more in the future than they are today if they continue to get more profitable and do business the right way. Obviously, not all companies will make that claim because there will be plenty of bad companies out there as well that just won't be able to keep up with the times. But in general, capitalism allows for efficiencies to take place, and we're on the cusp of an AI revolution, according to most people on CNBC that you hear from, and therefore that could be the next push in these markets in terms of productivity. Right? It may come at a price, and some people may end up losing their jobs and being replaced by AI, so that will be a different conversation. But in general, it could very well make high-quality businesses more profitable than they were before, because if AI can take the job of 3 humans that would have otherwise been paid a salary, that's money saved for corporations, and that should mean that they are worth more in the stock market's eyes in the future, especially if they're willing to share their proceeds and profits with investors through the form of a dividend payment. So we'll see if that takes place or not, but at least there is some sort of a reason or a catalyst as to why we should think that markets can become more valuable in the future. There's always something new out there that is allowing businesses to show improvements and better profit-making capabilities. So right now, we're not obviously anywhere near the highs of any of these charts from an all-time perspective, but we are at highs from a yearly perspective on some of them, like the NASDAQ is just one example. And in all four of these cases, we're showing an upward movement in the short term. Now with the Russell 2000, you'll notice it's the only one that has that pink background color. And that refers to, in this case, that we still have what's known as a death cross here, but it is showing improvements to the point where I would personally be surprised if it doesn't switch to a golden cross here in the short term. It could happen as soon as next week, because you can see that that orange line is curling higher. If I were to right click and maximize this so you guys can see this a little bit better, notice that that is very obvious to the naked eye, that orange line is curling higher. Remember, the orange line is the 10-week moving average. The blue line is the 40-week moving average. So the orange line is more sensitive because it's tracking less information, and it's the one that can move faster. And so it's gearing up right now because we've had a nice push out of the Russell 2000 here over the last month. So unless that just comes to a grinding halt all of a sudden, which would be maybe a little bit surprising, I would expect the momentum that's already built into the candles to be able to push that orange line up and over the blue line here at some point here this summer, hopefully sooner rather than later. So I think it's just a matter of time before we have all four of these 1040 longer term crossover charts with the bullish crossovers, what they would refer to as golden crosses in these cases. So things are looking good there. We have price, by the way, above the blue line. It's just that the moving average hasn't crossed the blue line yet. So I think that's going to happen sooner rather than later. The other charts look pretty good from that perspective because they've got a lot of momentum behind them right now. All right, let's pop back on over here to the internet. Let's not talk about races here. Let's talk about you guys supporting Market Scholars, which I certainly appreciate, and I know David does as well. There's a reason we ask you to support us on social media, because as a small two-person operation, we don't have a big marketing budget. In fact, our marketing budget is effectively zero. So the only way we can get our word out about our business in order to run it profitably, like I mentioned before, businesses exist to make profits. Of course, they also want to make products and services that are useful to their customers. Otherwise, there's no purpose for them to exist. And so that is the beauty of the economy that we have here in the United States. So while we offer these YouTube videos for free for everybody, and hopefully we can cast a wider net, and those folks that may not be able to afford our services, at least they can still get some benefit from us. We also obviously have a duty to ourselves to make sure that we made the right decision developing this business instead of staying in the gray corporate monolith that so many other people are in with their 9-to-5 where they collect a paycheck every 2 weeks. We've taken a bit of a risk in that regard, and hopefully we've made the right decision, and I think we have. But we could still use your help nonetheless. So if you could do us the favor of clicking like for us when we're doing these free videos, what that does is it gets our video out to a much wider audience than we would be able to on our own, because then that gets pushed out to your own social network. And obviously you have your own friends and family that follow you and that would not follow us. And you just never know when that results in a transaction at some point. So it's kind of one of those situations where we run a freemium service where we offer some things for free, but we offer some things for premium. And if we can have a good relationship where you scratch our backs by clicking like, we can scratch your back by providing hopefully good education to you for free on pretty much a daily basis whenever the stock market is open. So thank you to the 101 of you that did that for me the last time around. As I always say, as long as we're up and over 100 likes, I'm more than happy to give you a full length, closer to an hour-long presentation. On the other hand, if less and less people are clicking like and we're under 100, then I think it's probably probably a little bit better just for my time of my day to give you a slightly reduced free video there. So we'll leave that up to you guys to determine what path you want to take my videos in the future. If you like the shorter ones, don't click like. If you prefer the longer ones that come with the extra bells and whistles, then please take the 5 seconds out of your day to click like. Let's do some shout outs in that regard. Thank you to Teresa Huey for clicking like for us there. Thank you to Common Sense Investing as well, and a special shout out to Common Sense Investing because he is our newest premium market scholar. So we're very much looking forward to working with him for the next 3 years. And just today he got access to all 50 plus of our charts that you guys see us using on Thinkorswim, so that way he can make analysis decisions for himself, in addition to, of course, the 10 weekly classes that David and I teach only to our premium members, and our trading plans, and our position size calculators, and our drip trackers, and all the other tools that we offer. So a big warm welcome there to Common Sense Investing. I followed him here on Twitter for quite some time, and I'm glad to see that he'll be joining us officially here moving forward. Looking forward to getting to know you a little bit better from this point as well. Thank you to Dan as well. Thank you to Marty. Thank you to Irene. Thank you to Trunk. Thank you to William and Rich and Jim and David and Michelle and Randy and Ken and Pam. Dividend Cactus, been getting to know him a little bit lately as well. Welcome to Lucius and Judy, and thank you to Richie and Maria and Kiola, John, BZ Japan, Barry, Paul, of course. Thank you to David. Thanks to Dividend Stockpile. He's another good dividend account out there. Thanks to Lewis and Techmu Options. Thanks to Sunita, Business News, Carlisle, Ray, Sarah. The list goes on and on and on. I can't get to all of you, but I do want to say thank you and share my appreciation with you guys being willing to help David and I along with our request. Let's have a chat now here about the factor selector. And a reminder that earlier today, I taught my question and answer session for 3.5 hours. So if you're looking for additional content from me, there's 3.5 hours waiting for you on our calendar if you're a premium member of Market Scholars. And then as far as I know, David taught his portfolio management with ETFs class as well. I know he's been really busy. Strangely enough, David gets very busy in the month of June, I think because of a lot of the basketball coaching that he does, because they've got a lot of camps and different things in this month. So his schedule's been a little bit more back and forth than normal here lately, but I'm pretty sure he taught his class. So make sure you check out his recording as well. All right, so the factor selector is something that gets put together on Tuesday nights, and then we use it on Wednesday mornings in our factor-based swing trading class. Let's talk about the bookends first of all, because they stayed exactly the same. We are still in a market that is being led higher by quality, and from my perspective, the reason behind that is because quality has a very high correlation towards the technology sector right now, especially companies like Microsoft and Apple. They have some of the best credit ratings on planet Earth, and those are the types of companies that you will find in the quality factor. So when technology is doing well, there's a pretty decent chance that quality, the factor, is doing well, and that is the case right now. On the flip side of the factor selector, on the bottom side, dividend yield still not clicking. Now I will say it's gotten a little bit better. Some of you might have seen my tweet in that regard. When was it? I think yesterday I had made that comment. Where was it? I think it was yesterday afternoon, perhaps. Yeah, right here. I wanted to point out that, a week prior, on June 1st, the most amount of companies that I would consider to be attractive appeared at a 47% rate. And so that's basically half of the stocks that we track on the CCC spreadsheet, companies with 5 years in a row or more of dividend increases. Basically half of them would be considered at historically attractive yields at this moment. Well, just 1 week later, not even quite a week, about 6 days later, that number moved down from 47, basically the all-time record since I've been tracking it, down to 40. That's a huge move in a very short amount of time. It usually does not move that quickly. But what that tells me is that dividend stocks have been being bought up to a larger degree in the last week. They still have a long ways to go, which is effectively what this is telling us, them being at the bottom. But that was kind of like the extreme wipeout, like rug pull at exactly the end of May to give us that statistic. And we've had a nice snapback recovery in the first few days of June. Now, obviously, it's still a precarious situation, and we don't know where it goes from here, other than to say it has been a nice response from the extremes that our indicators were telling us just 7 days ago. So we'll see if it's enough to get them off the bottom of the mat here in coming weeks, but for right now they do remain at the bottom. And then in the middle, we had transitions across the board. So quality and dividend yield have been first and last for the last few weeks. But in the middle, in the rankings 2 through 5, we had a shakeup in all of those. So low size made a nice move higher, and we talked about that on Tuesday, remember, when we talked about the Russell 2000 in this presentation, and I said, from my perspective, it's probably the banking stocks that are causing that for the most part in the Russell 2000. And here you can get confirmation with your eyes that the Russell 2000 is making a heck of a move. Now, I think it would have been obvious anyway, just looking at the charts like we've already done, but this helps maybe confirm that what we're seeing is truth. The low size area, which goes beyond the Russell 2000, but that's your best kind of overlay from a major market perspective. But that has been a nice little snap higher, right? We were just a month and a half ago, we were talking about how the low size factor was the worst. And that made sense because the banks couldn't get out of their own way. But here over the last week or so, we have seen a vast improvement on that count, and that has really benefited that low size factor. It did push momentum out of the way. Now, I haven't even really seen much in the way of deterioration out of momentum. I think momentum is still strong right now. I just think that low size had such an epic move that it couldn't help to replace momentum. So it's not like momentum went down because it was weakening. It's simply because low size was going up so aggressively, it just replaced it up there. Value had a nice move as well week over week. Likely same conversation there. You have a lot of financials and oil companies in the value factor right now. And then low volatility fell. And, judging by what I've seen lately, that makes sense as well. Remember on Tuesday, we were talking about how healthcare had rolled over, and we've been talking about the struggles that consumer staples have had for a while. Those are two critical areas to the low volatility factor. So anyway, we've had a bit more movement here lately, but the movement has really been kind of in the middle areas, some repositioning that's taking place in there. All right, let's go ahead and take a look now at some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And as we're pulling this up here, you can see kind of a mixed amount of charts in terms of pink versus green. And a reminder for those of you that might be newer, on these 12 grid charts, the background color will tell you what the current posture is. So it doesn't switch colors the way that our bigger 4 grid charts did. With these, it would mush things up a little bit too much since we're looking at so many more charts on one screen. So this is basically telling what's the current posture for each of these. And we usually get started with our conversation on this first set of 12 grids in the lower corner. So let's start our conversation with the US dollar. That was a pretty aggressive move. I didn't really hear anybody talking about that today either. That was a pretty big move lower by 0.8%. Now, Thursdays are a little bit different for me because, as I mentioned before, I was literally talking for 3.5 hours earlier today. And when I'm in the middle of teaching a class, I'm not really fully plugged in with what's going on in the market on an intraday basis. So that's probably the reason I didn't hear anything about the US dollar. But wow, as I look at it now, that's a pretty big move to the downside. Now, because it was in such an epic up move since basically, let's call it the beginning of May, even a sizable give back day like this was enough to allow it to retain its strongly bullish posture. But you usually can't have multiple days like that. So if we're down like this again tomorrow, I would say it's almost a guarantee that we go back to a bearish posture. It will go weakly bearish, remember, not strongly bearish. So it's not something that we have to fear necessarily, but it's just saying that there are clouds out there. We don't know if those clouds will develop into a storm or whether they'll blow out of the system and we'll have sunshine again. Let me right click on this real quick because I want to see how close it is even right now. It's a little surprising. I wonder if this is kind of getting horsed up right now because of this wild candle that we saw back here. Remember, we talked about it at that time. The dollar didn't actually move like this, but the ETF that tracks the dollar, kind of like the derivative of the dollar, did have one really chaotic 1 minute candle at the end of that trading session. I think it was probably a fat finger mistake or something clerical, but it wasn't actually the result of everybody just bailing on the dollar for 1 minute in time. That would not make sense whatsoever. So I do wonder if that is making a bit of an impact right here on this, because I expected this to look worse than it did. Even with today's 0.8% pullback, that green line is still rising. That's not what I was expecting. I figured it would be rolling over, but still perhaps at 86 or 85 or something like that, but rolling over. So this is a little bit surprising. So I may have to take that back, what I just said a moment ago. If we do have another day like today, tomorrow, it's possible this thing actually still stays with a strongly bullish posture, but I think it would be staying with a strongly bullish posture for the wrong reason. I think the way that this indicator is reading things, remember, these lines are kind of like a stochastic, where it's trying to track whether you are trading at near the highs or the lows of recent price ranges. And because this candle technically is part of the recent price range, it's probably going to look at this as kind of the low point recently, and this is as the high point recently. And obviously you are still trading near the highs and you're nowhere near the lows. So this is the downside of having one of those fat finger mistakes. It horses up the technical analysis of it as well. So anyway, what's kind of interesting about the dollar as I look at it kind of in a more granular detail here, you can see that we actually have what's known as a bullish intermediate confirmation signal on it today. However, you will notice that the red line is literally at the lows, 0.00. You don't see that very often, but that is literally the lowest it can go. And remember, when it goes below 5, we sometimes get a little bit nervous that that's such an extreme move in the short term that it could pull down that whole chart. Right now, I'm kind of mixed in my mindset regarding that, because we do still have a chart well above its rising moving average to offset that. So I'm not sure it'll play out exactly that way this time around. Nonetheless, thought I would point that out since it does exist. The blue line is actually where you do want to see it, because this has been a decent move off the highs, right? The whole idea behind a bullish intermediate confirmation signal is it's a buy the dip signal. And sometimes you look at it and you're like, that's not really much of a dip. I think I'll pass type of a thing. This one's a legitimate dip. It's not like down near the lows or anything like that, but it has given off a healthy amount off the top, and it's retained its uptrend that it had been in otherwise. So that's kind of the idea behind the signal itself. So it's going to be interesting to see how this one plays out. It's too bad this candle has to horse things up here, because I don't think it's giving us an exact perfect outcome. It's not the indicator's fault. It's the fault of whoever was controlling the price action on UUP that day, and the fact that it was not washed away. Sometimes you have these glitchy types of candles where the powers that be will review the situation and will say, hey, we are basically eliminating those trades. They didn't really exist. They were just a couple of trades that were errant or something like that. But that wasn't the case here. There were legitimate trades going off down there towards the lows, and big amounts as well. So, I don't know, because I don't work for the exchanges, exactly why it happened, but I can understand why they didn't just wash this away. This kind of needs to be forced to stay on the chart for posterity purposes, because there were legitimate trades going off there, even if they were errant trades. But it does have that tendency of horsing up our technical analysis in this situation. Now, with the dollar struggling here today, remember our assumptions is that commodities can do better when the dollar is weakening, and foreign stocks should do better than U.S. stocks when the dollar is weakening. And we did get that partially today. Let me explain. Gold was up nicely today. That's a good move out of gold there, 1.32% to the upside. Obviously, you still got work to do. You're still below that falling moving average. You still have that strongly bearish posture. But hey, bouncing off of what would have been basically a 2-month low at yesterday's lows, that's a pretty good move right there. And so, you saw that positive benefit of a weakening dollar help the gold traders here today. You also saw the typical correlations or relationships hold in what we see with the foreign stocks up above. Both developed and emerging foreign stocks outperformed the United States here today, at least the S&P 500. So EFA was up 1.06%, EEM was up 0.71%. So both of those were probably aided by a falling US dollar. Oil didn't really follow suit. Remember, each market does have its own dynamics. Currency is just one of a number of things that can affect pricing. So all else being equal, currency is a very important precursor to what to expect, but there can be offsetting aspects, with geopolitical concerns or what have you, that mean that the currency is not the only thing that affects price action. So oil was able to kind of buck the traditional trend. It was down today, but keep in mind oil was up a bunch yesterday, so maybe it's just trying to kind of right the ship, so to speak. You did have kind of a wonky candle here today where you finished well off the lows on oil, but you still managed to close below the falling moving average. So you kind of have opposing thoughts there, where I'll say the same thing that I've been saying about oil for the last 3 months. You're still in a sideways holding pattern. You don't have any sort of real indication, bullish or bearish, where this thing wants to go. It's got a weekly bullish posture, but the moving average itself is still trending lower. So from my perspective, if I were forced to take sides, I'd probably be more inclined to take the bearish side, but there's just not enough bearish evidence here to go hog wild with that concept at the moment. So we'll await further information out of oil, but it was a tough day for oil, down 1.93%. In terms of the 10-year U.S. Treasury yield, that was quite the crazy candle there as well. So, there were some macro movements today for sure. TNX, take a look at that candle again. I know it's harder for you guys to see, so let me blow this up. And you'll see the size of that candle today was pretty massive, right? It's not quite as aggressive as we saw back here or maybe back here or that one. So they do occur that way, but it was immediately following what was a very aggressive day yesterday to the upside. So you almost eliminated all of the movement yesterday in one fell swoop. So anyway, pretty wild movements here lately in interest rates. But where we stand, despite having a pretty ugly day today, we ended at 3.71% on the 10-year, and that remains with a strongly bullish posture and above its rising 30-day moving average. Remember, when yields fall or interest rates sell off aggressively, typically bond prices go up, and we did see that nicely across the board in our bond categories here. Notice that TLT ripped higher, basically offsetting almost all of yesterday's loss. Remember, I still have an iron condor going on TLT. That one's doing just fine the last I checked. So I kind of like this behavior where it's up and down and not really making a big trending move in one major direction. But that was a pretty good move out of it back to the upside today, up 1.17%. It remains with a strongly bearish posture, however. The foreign bond market was up 0.25%, so not quite as aggressive, but still a decent day for it. It also remains with a strongly bearish posture. And then let's talk about high yield bonds, because they had a nice day, up 0.63%, and are now back above their 30-day moving average, and now have a strongly bullish posture here as well. Again, I wouldn't really throw a parade for that trend. It's still kind of aimless, moving sideways, but at least it's showing us that the high yield bonds could represent the leadership group out of the bond category out there at the moment. So, we'll see where that takes us, but, at least worth mentioning that it's back above its moving average once again. Bitcoin slipped below 27,000 since the last time I was with you. It remains here at about 26,500 or thereabouts. It's kind of just meandering. It's not really making aggressive moves. Earlier this year it was making plenty of aggressive moves higher. Last year it was making plenty of aggressive moves lower. This is kind of just a slow drip more than anything, where it's just trying to figure out whether it's got the mojo and the gumption to get back above that moving average. Every time it's attempted it here in the last month or so, it's failed, but it hasn't rejected it so aggressively that you're worried that this whole thing is just going to collapse upon itself. So it's still within spitting distance, and it could make a bullish move at any given moment. For right now, you probably want to be in that wait and see camp and await further information. So the trend still is to the downside in the last month or so, but it could easily break to the upside given the right type of information. Let's take a look at our sectors now. Chart 5C for those of you following along at home. And here we have a little bit more to celebrate, a lot more bullish charts than bearish ones. The only pink chart that remains on the board is the consumer staples. Remember what I mentioned before about the factors and how low volatility was struggling lately? The staples are a big part of that low volatility conversation. They were up today, but they've been challenged this week. There were some companies like, I think, was it Campbell's or ConAgra? One of those two came out with earnings this week, and Wall Street didn't really like what they saw out of it. So there's been a little bit more, input cost pressures and things like that going into the packaged foods industry. So that has put a lid on any potential advance out of the staples here more recently. But at least today, it was able to go higher on an up day for the market. And you do have some fairly recent oversold cluster signals, so you never know when that might get click into the upside. But they're the only one that has the pink background. All the rest at the moment back to green. And some of them look better than others, naturally, as is always the case. The ones that look the worst right now, I would say, are utilities and healthcare. Both of them went to weekly bullish posture, but both of them remain below their falling moving averages. And so I'm a little bit more leery of their charts at the moment until they can prove to me that they want to get up and go. Whereas the winners that we've had recently have been along the lines of communications, technology, and discretionary, and they all still look pretty darn good, all things considered. I would also throw industrials into that conversation as honorable mention. Its chart doesn't look as pretty from a trending perspective, but the move that it has made in the last week and a half is noteworthy. We basically went from near 3-month lows to near 3-month highs in one fell swoop. So industrials making moves out there, and that was part of that Boeing conversation I had with you at the beginning of the presentation here tonight. In terms of who today's biggest winners and losers were, let's see here. It looks like discretionary was our biggest winner. It was up 1.48% today, thanks to Tesla and Amazon. Remember, these are the market cap weighted sector ETFs here. And then our biggest loser today would have been, let's see, real estate. It was down 0.61%. All right, let's get into our trade application example now. And since we did a bullish swing trade on Tuesday's presentation, I figured let's turn it around and balance it out a little bit with a bearish swing trade here today. And one area that I've been eyeing for bearish trades is healthcare, because it had this nice reversion to the mean move off of these oversold cluster signals, came up and touched that downward trending 30-day moving average and rejected it and pushed it back lower. It was up today, but you kind of have that, uncomfortable feeling like you just don't know if it's got the energy to get up and over that moving average. So I specifically went out of my way to look for, some bearish trade candidates out of healthcare. And what I came up with here today was ticker symbol X-ray. Now remember, this trade was already done when the market was open. My apologies, by the way, for getting it out a little bit later than I would prefer. It was one of those situations where the darn thing just kept on falling on me, and I had to keep on readjusting my order lower and lower and lower. Here's what the final 15 minutes look like of this chart here today, where you can see it kind of topped out right here at 38.91, and wouldn't you know, I originally put the trade in to short it at 38.90, and as soon as I put it in, then it drops, and then I lower it to 38.85, and then it drops from there, and then I lower it to 38.80. So it was just one of those days where it doesn't normally work that way, but sometimes when you have pretty much a straight line in the final 15 minutes, I find myself scrambling to get filled at an appropriate price, and then sometimes you just got to throw in the towel and just get the trade done. So anyway, we got the trade done, maybe not at the price I originally wanted, but we're still up a little bit as it did basically close near the lows of that final 15-minute push there. And here's the reason that I was targeting this ticker symbol X-ray here today as a bearish trade. You can see it kind of looks like the healthcare sector where you had this big move lower that resulted in oversold cluster signals that we have now witnessed the pushback towards higher, the reversion to the mean type of a move there, but it failed to get up to that downward trending 30-day moving average, and today it looked like it wanted to start rolling over again. So that was kind of the mindset behind why I targeted it as opposed to a lot of others for this type of a bearish trade. The other thing I'd point out is it's got a little bit of a bearish near-term divergence signal where you've got this peak in the blue line down below, followed up by this other peak right here just yesterday. So you have lower highs in those two blue line peaks associated with this candle right here and this candle right here. So price went up at a time when the underlying indicator was deteriorating, which then led to today's sell-off of 1.73% when the stock market itself was up 0.6%. So obviously an underperforming stock today. It's been an underperforming stock over the last 3 months as well. As you can see, its price candles are below this S&P 500 gold dotted line up above here. So similar to Tuesday when we took that Unum trade, X-Ray is not the world's most liquid company either, so it doesn't have the best options contracts that are available. So this was just a straight stock type of a trade and another one-for-one reward risk relationship. So short sold it in a margin account, put our stop loss up here above 40, and our price target is down here closer to about 37.5 or thereabouts. Remember, you can get the specific numbers if you're a premium member in our Telegram alerts channel. Okay, so that's what I had for you here tonight. Hope you enjoyed the presentation. If you did, I have one simple request for you. Simply click like for me there on Twitter. That will encourage me to put together another full-length video for you on Tuesday. Otherwise, if you do prefer the shorter videos, then don't click like, and that's fine as well. Either way, I win. Either I get the message out to a wider audience by having you guys clicking like a lot, or I get to save myself a lot of time because it's a lot easier for me to do the 15-minute version of the video than the hour-long one. So either way, I'm good with it. So you guys collectively will decide what direction I will take it. So whatever you decide, I appreciate you checking out tonight's video. I will wish you a wonderful weekend. We'll be watching some NBA finals, hopefully getting outside, enjoying some nice weather, maybe grilling up a steak or something. But however you enjoy your summer weekends, I hope it's a great one for you. And then I'll see you guys all early next week. So until next time, best of success with your trades and your investments. Goodbye for now.